big changes have been announced in Singapore's tax system. Among the key moves, the hike in the Goods and Services Tax, or GST, will start in 2023 and will be staggered over 2 years. Higher taxes on high-income earners and increases in property tax. Carbon tax of $25 per tonne from 2024, going up to as much as $80 by 2030. So how will these changes affect investors, businesses and consumers? Joining me to discuss are Professor Sam Ee Loong from the School of Accountancy at SMU and Rohan Solapurkar, who is tax partner at Deloitte Singapore. Welcome, gentlemen. It was a very interesting budget this year. The big news, of course, GST hike has been deferred. The consumers are possibly happy about this, but what about businesses? Prof. Sam, what's your take?
I think since 2018, when the then Finance Minister Heng Swee Keat announced the proposed increase in GST, he already primed the people and the businesses that GST will increase by 2 percentage points. And it was made very clear earlier on this year and towards the end of last year that there will definitely be a 2 percentage increase. But as I mentioned before, GST is really a tax on consumers, not on businesses. So I would think businesses would not be too concerned about the increase in GST.
Rohan, let me just ask you, the whole slew of taxes that were announced, talk to us about how it will affect the investor community.
So if you look at the sort of increase in taxes that came about, right, and I'm breaking them into 3 or 4 buckets. So no change in corporate tax rates. Personal income tax rates at the higher level have been increased by a percentage point. So between 500 to a million gone up to 23%, above million gone up to 24%. I think that might have a small impact on individuals. But the larger ones are the carbon tax and the property tax. Now, the property tax is, as the finance minister himself alluded to, is sort of a tax, wealth tax, because if you look at the bulk or the increase in the property tax that's happening towards the non-occupied houses, right? And the significant rise comes into landed properties or very large landed properties. And by very definition, those are owned by the wealthy and those are owned by the rich. And therefore, it's only fair to tax them a little bit. So the actual net outflow of cash, if one has to look at it, is not a significant amount of money for a wealthy individual owning it.
Prof. Sam, Mr. Wong announced a deficit of $3 billion, so that makes 0.5% of GDP. Does that surprise you?
Not really. If you look at before COVID, Singapore, whoever the finance minister, whenever they presented the budget, they would project a deficit. But at the end of the day, they usually end up with a slight surplus. So the government is very conservative in projecting a budget deficit. If you look at what we did in 2020 and 2021, we actually did very important measures to safeguard the Singapore economy and the employment of individuals. So if you look at the employment figures, our unemployment rate is actually very low. And this year, the unemployment rate has actually continued to move down. So unlike, say, for example, in US, where they literally put money in the pocket of public, in Singapore, they actually help businesses suffering from COVID and help preserve jobs.
Rohan, how will the impending corporate tax changes impact business competitiveness here in Singapore?
I don't think it's going to have a significant impact, because if you look at why multinational, so let's understand this. This impact is largely going to be for multinational companies who have an income above a particular threshold and who have tax incentives in Singapore, then therefore get taxed at lower than a 15% tax rate. What the impending corporate corporate tax changes are going to bring about is to have a minimum tax rate of 15%. That means any company in Singapore that's taxed lower than 15% is going to come up with a top-up tax of 15%. Now, this means that you look at it in the broader context, why do companies come and establish their presence in Singapore? Not necessarily only for tax rates. I think tax is a consequence of it, but they come here because of a variety of reasons, right? The infrastructure, the connectivity, the talent pool, the good, strong banking financial capabilities that we have. So there are myriad factors that bring in investors. And the fact that we have a very strong political system in Singapore also adds to our credibility. So the fact that there's going to be a increase in tax rate that's going to happen over a period of time is really not going to drive away investors.
Gentlemen, this one I'm going to pose to both of you, and I'm going to start with a quote from the finance minister, who said during the speech, "There are no painless solutions. Ultimately, every need must be paid by someone. Every dollar not paid by one person will have to be made up by someone else. If not today, it'll be in the future. We know that those with less will receive more, but how do we know who ends up paying more?"
Clearly, those who are wealthy will end up paying more. But also, we must recognize that those who are wealthy also have access to, perhaps a good team, a good set of advisors to advise them on how they could look at loopholes or perhaps look at tax planning or sort of deferment of taxes. But having said that, I think it's only fair that, and I do hope it is the actuality, is that the wealthy will pay more, and that's only correct.
Prof. Sam, who will bear the brunt of the bill?
Well, it's very clear the bulk of the increase will be borne by the high income group, by the wealthy. And the minister actually, if you notice, he emphasizes so much on the social compact. If we look at the US, if we look at Western Europe, because of the huge income gap, wealth gap, it creates a lot of social tension. And if you look at what the minister has done, he is actually brave enough to impose quite a lot of additional tax on the rich and wealthy, and at the same time, pass it on to the lower 20% income group.